Buenos días, vamos a hacer ahora un repaso de los mercados. Toca mirar ahí a los mercados y lo vamos a hacer con Moya, que es Senior Market Analyst de Oanda. Buenos días, Eduard. Thanks for joining Negocios.
Oh, thank you for having me.
So we are facing Fed's meeting. What can we expect from Powell's speech? Is he going to send a message of calm to the markets, or will he opt for an unclear speech?
Well, I think Fed Chair Powell is going to try to keep his same rhetoric with avoiding any hints that the Fed is close to tightening. I think that much of the attention will come with the updated forecasts. The last time these forecasts were done in December, and that was before we had roughly $3 trillion of stimulus get approved. So I think the Fed is going to have to strongly upgrade their growth outlook forecasts. And they're probably going to maintain that stance that interest rates are not going to rise, not this year, not next year, but maybe in 2023. So the Fed is going to try to push back against the bond market. The bond market is really focused on the economic recovery. It seems to be gaining speed, and Treasury yields will probably continue to push higher. So the Fed might slowly start to push back, and maybe they'll announce that they're ready to act, or that they're going to provide some tweaks in the near future, and that might be enough to alleviate some of the pressures that are brewing in the bond market.
So in this context, is it time to invest in fixed income, or is it better to opt for stocks?
Well, I think there's an interesting survey that came out today from Bank of America. And what it showed is that I think still the majority of money managers still think that we're in the late stages of a bull market here for U.S. equities, and that you're probably going to see investors are still going to try to ride the reopening of the economy, which is going to benefit these cyclical stocks. So I think right now you're probably going to see that stocks are still going to remain the favorite trade, but I think that the risks are growing. I think right now, for the last 12 months, the focus has been solely on COVID, and now these fund managers, they're primarily concerned about inflation or the Fed's tapering and the potential taper tantrum that would happen with stocks. So I think that you're probably in the short term still in for a period of a much higher U.S. equities, but I think probably by the summertime you're going to see investors become a little bit more bullish on fixed income, as you're going to probably see Treasury yields be north of 2%.
And what else can we expect from the markets in the short term? Like, for instance, Chinese markets turn negative. Is this going to shift outside China and impact the global markets?
Well, I think with China, what we're starting to see is they're really transitioning their economy. They're becoming more consumption based, and I think right now you're probably going to see that when you take a look at the growth prospects. Still, China is where a lot of investors want to be investing in. I think that there's still this belief that you're going to have the most rapid growth from China, and investors are just they don't want to shy away from that type of, I think, gains that we still could see, as their economy is likely to steadily grow over 6%. And I think you're probably going to see that with the COVID story right now, Europe is completely underperforming. And I think there's this belief that you're still going to see some growth exceptionalism from Asia and also the US. So I think those two trades are still going to remain in favor in the short term.
And which will be your advice for investors in terms of companies or industries?
Well, I think right now, because I think this week there's been so much focus on the AstraZeneca vaccine rollout across Europe, and how you have so many major countries that are now kind of pausing inoculations. And I think what you're going to see is that the belief, and I think for all the health experts I've been listening to, still believe that vaccine is effective. And I think what you're probably going to see is that there might be some vaccine hesitancy, but I think Europe is going to have a strong rebound, probably a couple more months down the road. But I think Europe is going to probably provide some of the best, I think, upside returns. And you're probably going to see the stock 600 remain fairly attractive. I think right now we've seen the UK has really outpaced the broader European area, and I think you're going to see that investors are going to wait for the acceleration in growth outlooks for Europe, and I think Germany, France are going to lead the way, and that's probably going to happen once they have COVID in their rearview mirror, and I think you're going to see that that's maybe another couple more months before vaccines are steadily distributed. And I think it's a messy outlook in the short term, but I think you have to look at European assets right now.
I hope we can see that rebound in Europe and also that vaccines are effective. Eduard Moya, Senior Market Analyst at Oanda, thanks for joining Negocios.
Thank you.
Les dejamos con este análisis de mercado de Eduard Moya. Seguimos haciendo ese repaso a los mercados, esta vez de la mano de Brian Vending, President and Managing Executive at MGIP Wealth Advisors. Brian, thanks for joining Negocios.
Thank you for having me.
So we are just expecting Fed's meeting. So what can we expect from Powell's speech?
Sure. Well, it's a very important meeting this week just to get additional updates from Chairman Powell and the FOMC regarding the dot plot of interest rates moving forward for the U.S. economy, and as well as getting assessments from the Fed on their projections of inflation, as well as the breadth of the economic recovery that's happening around the world and domestically in the U.S. Relative to the pandemic. I think the expectations from the Fed is to maintain an easing interest rate policy. They made it very clear that they are open to inflation running at above their 2% CPI target, and to continue to help to support the economy recovering over the balance of the year into next year.
So in this context, is it time to invest in fixed income, or maybe is it better to opt for stocks?
Sure, that's a great question, and I think a question that's on the minds of many investors. I think right now you should expect that over the balance of the year, inflation should continue to rise, longer-term interest rates should continue to increase. That is something that is a headwind for fixed income in general. I think the types of fixed income that traditionally do a little bit better in a rising interest rate environment are floating rate notes or bank loans, which is one element of fixed income that they could have an opportunity for appreciation. But I think moving forward, we are definitely optimistic about a broadening economic recovery. So if I had to choose between equities versus fixed income, I think it makes sense to stay broadly diversified on the equity side, and probably have an element of fixed income just to minimize volatility, but tilting a little bit more to equities is where I would structure the portfolio.
As you said, we saw how inflation rise, but can we assume that this rebound is circumstantial, or is it and that is not structural? Sure.
Another great point. I think when we think about policies that are being passed around the world right now, between monetary policy and keeping interest rates low for a longer period of time, but also seeing that there is a lot of fiscal policy stimulus as well. I mean, for example, in the U.S., recent fiscal policy aid bill was passed for $1.9 trillion. This is being targeted directly at consumers, individuals and families, state and local governments, very similar to other fiscal relief measures around the world. I think with that aid, plus the fact that vaccine adoption is occurring more efficiently around the world, with more and more people getting vaccinated, both of those measures between easing monetary policy, fiscal aid stimulus, as well as improvement on the vaccine front, can help to support more of a structural recovery for the economy, the economies around the world. And I think relative to that expansion of economies around the world, that's why I think we should expect inflation to rise. I don't think it's going to be as dramatic as inflation that we saw back in the 1970s, but we definitely should expect that demand will be there and something that should be consistent over the balance of the year.
One last question, especially for our audience. Which will be your advice for investors in terms of companies and industries?
Oh, absolutely. Thank you for that question. So I think when you think about a broadening economic recovery where you should expect to see, specifically here in the US GDP rise to levels of at least 5% or more, you want to be in sectors of the economy that's tied to that GDP expansion. So that's why we are encouraging our clients and investors to have allocations to industrial sector, the basic material sector, financials, if you so inclined believe that interest rates are going to continue to increase over the longer term. And I think those cyclical sectors that are tied more to the expansion of the economy around the world will probably perform well over the balance of the year.
Okay, so we note down those recommendations. Brian Vending, President and Managing Executive at MJP Wealth Advisors, thanks for joining Negocios.
Thank you very much for having me.
Hasta aquí ese repaso de los mercados y tomamos nota de esas recomendaciones de Brian Vending.